Hey guys, John Paulamy here, Actionable Intelligence. Today's Sunday, March 31st, 2019, and this is the weekly market update. Okay, so this week I'm mostly going to focus on oil, and what I wanted to point out, first of all, was the fact that since the oil price crash in the fourth quarter of 2008, which you can plainly see on this chart, we've had a steady recovery, if you will. We had an initial V-shaped recovery, and then we've slowly been grinding higher. And last week we saw the price of oil over $60 a barrel on West Texas Intermediate. So this is what we expected. It's consistent with what the fundamentals are showing, i.e. the cutbacks by OPEC, specifically Saudi Arabia. And I think that quite a few people in this business or in this industry are missing the big picture as to why the prices are moving higher. I will get into that later on in the video. But suffice to say, the Saudi Arabians want the price of crude higher. They need it higher. The new sheik there, MBS, 33-year-old guy that's running the country, you know, he sees that oil is 93% of Saudi Arabia's exports. They were living high on the hog for many years. They had so many foreign workers working there, and they had extensive and very generous welfare benefits for their population. They mostly had Filipinos and Pakistanis and Indians and people from the US and UK working in their country doing a lot of the work. They're trying to transition now. They understand that the oil is eventually going to run out, and they need revenue in order to complete this transition, if you will. I mean, they basically have a $500 billion project going on where they are creating this new city, if you will, new transformation of the Saudi economy. So $48 a barrel of oil isn't going to cut it. Now, oil is a very political commodity. You've seen recently Trump is again out there tweeting again that they need to get the price of oil down. But, you know, there's a lot of backdoor things going on. We just saw recently the revelation that the United States has been having negotiations and is moving forward with some nuclear power transfer, technology transfer to Saudi Arabia. And the reason why they want to do this, I think, is twofold. Is number one, you know, if you develop your nuclear program, you can also, from the reactor waste, if you do certain things, you can obtain weapons-grade plutonium. So we kind of want to stop them from doing that, because we don't want proliferation of nuclear weapons. But also, I think the Trump administration sees the United States falling further and further behind the Chinese and the Russians in the export of nuclear power technology. But anyways, this slide, you know, this first headline is from a Bloomberg headline: Saudi Arabia shoulders OPEC's oil cuts, Russia eases in. We'll show that later on in a graph later on in the video. And then this other headline, which is from Seeking Alpha, from an analyst I follow over there, HFI Research: Saudi Arabia is set to drop exports even more. And I think that is one of the key things that most people are missing. The oil price is moving higher because OPEC is being disciplined in cutting back on production so that they can get the oil price up. I don't know if it's going to be able to be maintained, but I don't know how high they're going to go. I can see $70 later on this year. On West Texas, that'll be about 80, 82 on Brent. But they definitely want to try to get to a higher equilibrium price. Whether they can get the cooperation of the other members, whether Russia will cooperate, what will the Trump administration do, I don't know. However, that seems to be the goal. Now, this is an interesting guy to follow, or person on Seeking Alpha. I'll put a link to this particular article where I got this analysis. I've been following this person for a while, and they've been pretty good. They do a lot of data collection, and they write about a weekly article every 10 days about what's going on in the oil markets around supply and inventories. And some of the three things that this HFR analysis, if you will, or it's actually HFI research, but anyways, basically we all know that the Saudis basically were oversupplying the U.S. crude market, and it wasn't shale that was doing it. It was the Saudis oversupplying the market, and at the request of the Trump administration to keep oil prices down when everybody thought that the Iranian sanctions would go into full effect late last year. Then we all know the story. The Trump administration double clutched everyone and gave waivers to a lot of our allies or people that we're friendly with, India, Japan, other countries, such that the Iranians could export oil to those countries. Now, when the Saudis and a lot of rest of our allies in OPEC were overproducing, then that created the glut and the price crash in the fourth quarter. So the Q4 2008 oil market surplus came from a surge in exports from the Big Five: Saudi, UAE, Kuwait, Iraq, and Russia. As a result, the reverse will send the market to a deficit. If they cut back, then we're going to go into a deficit, and that's what you're starting to see. That's why you're seeing the price slowly grind higher. Another thing that is not discussed is crude quality. Heavy crudes versus light crudes. The refineries along the Gulf Coast of the United States are particularly geared to refine lower grade sour crudes from Venezuela, Mexico, Colombia, places like that. They are not necessarily able to refine efficiently the sweeter crudes that are coming out of the Permian. That's why that crude is being exported and why we are continuing to import heavier crudes. It's not something you can just flip a light switch or do one, turn a screwdriver here or there and you can change crude grades. It's not. Billions and billions of dollars of fixed costs have been made to use these particular lower grade crude oils that are no longer are becoming less available. I would suggest, though, that this is going to be particularly beneficial to one other sector, and that's the Canadian heavy crude producers. I have one of those in my actionable intelligence alert portfolio. Right now, that is the most beaten down sector in the energy sector, is the Canadian heavy crude producers. And I think that we are starting to see the differentials between WTI and Western Canadian Select have tightened. And I think that if the Venezuelan situation continues and the Saudis continue to cut back on their heavier crude exports to the United States, that the void could be filled by the Canadian heavy producers. We could actually see that crude go into a pricing preference to West Texas Intermediate. So crude quality matters. Not that many people understand the different qualities of the crude, the different API values, the difference between sweet crude and sour crude, how the refining process works. Again, most people are generalists. They don't really deep dive this stuff. But as a lot of people that I follow on Twitter that are experts in this have been saying, crude quality matters, and people are just not following it. So this could have a significant effect on pricing going forward. So this chart is interesting. It's from that same HFI research. And this shows basically the crude storage, if you will, in hundreds of millions of barrels in the U.S. on the left side, on the vertical axis. And you can see the different years at the bottom. You can see the 5-year average. Then you can see 2016, 17, 18. And then the big blue, the red line right here is what the actual inventories were in 2018. And you can see how they ramped up in the fourth quarter. This caused the glut. You can see this is the calculation of what would have happened if the Saudis and the Big Five would have not raised production to compensate for the supposed decline that was going to happen in Iranian crude. So this is U.S. crude storage versus U.S. crude storage if Saudi kept exports to U.S. at 700,000 barrels per day. So you can see why we had the big price decline in 2018 in the fourth quarter. This basically tells us that we know the Saudis are cutting back. It's being tracked. and they are actually cutting back more than they actually said they were going to do at the previous OPEC meeting. So if this is true, that price declined because the market was oversupplied, then the reverse seems to be accurate also, that as the suppliers, particularly Saudi Arabia and some of the others in OPEC, cut back, then we should see inventories begin to shrink, and that's why we're seeing prices move higher slowly but surely. Again, here's what's going on in real time. Again, you can see the Saudi plus UAE plus Kuwait plus Iraq plus Russia plus Iran plus Venezuela crude exports in totality. And you can see how recently, since basically the beginning of the year, how they've plunged by a couple million barrels per day. This is pretty significant. This is why I suspect that as long as they can keep the discipline, you're going to see the crude price continue higher. Again, we don't know what the politics will mean. We don't know what's going on behind closed doors with Saudi Arabia, MBS, the Sheikh there, and the Trump administration. We do know that the president has been tweeting to raise oil production, but again, crude quality matters. And if they do increase production, it will matter what types of crude are being increased. So I think this is interesting, because I don't think people are really paying attention to this. So you can see that the production is definitely, I mean, it amounts to a couple million barrels, but over a month, that's 60 million barrels. You know, over a year, it could be, you know, hundreds of millions of barrels. I don't think it'll get that radical, but definitely there is a drive by OPEC and these people and the countries that produce the most crude to drive inventories down and get the price up. It's in their best interest. So I think that's why we can be looking for, I think crude prices are going to surprise to the upside. I don't think people are anticipating seeing $70 or $80 a barrel crude. I think it's possible. I definitely think 70's in the bag for later this year. And depending on what happens and if discipline is able to be maintained, I believe there is an OPEC meeting in June. We will have to see what the price is at that time and what the political situation and economic situation is around the world, whether or not the cuts will be maintained. Now, another interesting tidbit of information that I thought was very interesting this week is that the Scotia Howard Wheel Energy Conference took place in New Orleans last week. And what was interesting, at least in the offshore portion of the conference, was the multitude of positive comments that seemed to come out of there. For example, we have the chief financial officer at ENSCO is quoted as saying, quote, "The offshore recovery is underway today." Quote, "This isn't something we are waiting for." And I will go into it later in the next couple slides from the presentation that ENSCO gave there. And it's actually showing that that is factually true, that activity is definitely picking up. And we are definitely in the early innings of a offshore recovery. After nearly half a decade of consecutive spending cuts, that's been since about 2014, the offshore industry is expected to finally boost spending again. And why is that? We've talked about it over and over. As the price of oil increases, cash flows to the producers increase, and they are in the business of producing oil. So once they become cash flush, that's what they do. They're in the business of finding and producing oil, and if they have money, they're going to go out and find and produce oil. That's how it works. Yes, there's been a lot of discussion about shareholder returns and returning capital, but as I've emphasized ad infinitum, this is an extractive industry, and the oil that you produce every day doesn't just, reproduce itself. You have to go out and find more oil to replace the oil you're producing, or at some point in the future, you will go out of business. And we are beginning to see that. We are being able to see the reserve life indexes, the measurement of how much reserves that oil companies have has been in decline. Obviously, why? They're not spending money to replace their reserves. So we've been talking about it for over a year. People are not patient, but the laws and fundamentals of economics and supply and demand do work. The cure for low prices is, in fact, low prices. So what I found interesting is that here's a quote that was basically, or not a quote, but some information from the presentation that Hess gave, and they were talking about a new offshore find, offshore Guyana, which is very prolific. And Hess is developing this Liza section with Exxon Mobil. And what they said was to produce the equivalent of 120 barrels a day of production in the Permian Basin would need $12.8 billion investment. To basically produce the same amount of oil offshore Guyana, it would only cost them 3.7. So what you can see here is that I don't think people understand a lot of projects offshore are actually cost competitive at $35 or $40 a barrel break even. And I think, you know, with the sediment being so bad when the oil price crashed a few years ago, I mean, there just was no appetite. I mean, you're not going to go to your board as the CEO of, you know, BP or Total or whatever, or Exxon, and say, yeah, I want to spend $2 billion on this offshore project, and you're right in the middle of basically an oil price depression. I mean, people just don't do that. So I think sediment has changed. Obviously, price does that. People can see that their reserves are declining, and I think that, you know, they're cashed up. So it's easy to sit down with the board with the balance sheet and say, look, we have this many billions of dollars in cash. We have the ability to, you know, do these projects. There's a lot of slack in the supply chain in the shipyards for building the rigs in the offshore sector. So prices are down. This is the time to sign long-term contracts and start making forward progress in finding new reserves and developing them offshore. That's how the cycle works. This year, this is coming out of the conference also, this year explorers and producers are expected to boost offshore spending 3% to $155 billion. That's just for offshore, and increase it another 10% next year. I thought this was an excellent tidbit too of a precursor, if you will, of future activity. FMC is a big time producer of basically subsea gear and wellheads. You know, when you drill a well in the ocean floor, you have to put various gear down there to control the flow back to the surface. And right now, the FMC is a big producer of this equipment, and they just had a record quarter for inbound orders of subsea gear. I think that's a precursor, if you will, of future activity and a good omen. Now let's get into the ENSCO presentation that was part of this conference that they talked about. As you can see, the top chart, if you will, is the capital expenditures by major exploration and producing companies. You see that the max was $218 billion in 2014. That's basically the top of the market, and we've had 4 years of decline, where last year capital expenditures offshore by major producers was only $97 billion. And this coincides with a decrease in the reserve life index. What's reserve life index mean? That means how many years, you know, your reserves divided by your current production tells you how many years of reserves you have left. And you've went from a high of 12.9 years down to a low of 10.7, basically back where you were in 2010. So, you know, basically, if they don't get the production up, they have about 10 years of reserves. Now, that doesn't mean that we're going to run out of oil in 10 years. They just need to go out and make the necessary investments where the oil is and start spending money. So, like I said, there's, you know, we do know from our analysis of the industry, there's quite a bit of slack in the industry, but I believe that'll be taken up quickly as money is recycled into new projects. And I think that's going to be the catalyst for us to make a considerable amount of money here over the next couple of years. So higher cash flow leads to more spending. So here's the free cash flow breakdown against the oil price for exploration and production companies. So you have the average Brent price in light blue, and you have the free cash flow breakdown in you know, of these oil companies. So you can see that at 70, 67, 70, free cash flow, coupled with higher oil prices, have created a more conducive environment for new projects. I think the crude price is going higher. I think cash flows will go higher. I think that, as you can see, here's the free cash flow of major offshore E&Ps. Basically, it was negative cash flow the last 2 years, $65 billion last year, or in 17, 118 billion, and now forecasted at 110. So despite the recent pullback in oil prices, expectations are that major E&Ps continue to generate significant free cash flow in 2019, giving large offshore customers greater flexibility to invest in future production, which we have reiterated they must do, or at some point it will be a problem. Don't forget, it doesn't matter, how much shale is developed. I mean, shale is not going to double from its current production rate and keep doubling and doubling. I mean, we still get 30% of our oil from offshore. That hasn't really changed too much over time, by a few percentage points here and there, up or down, within a band anywhere from 25 to 35%. It's not going to go away. And, we haven't invested significant amounts of money. It's been in a depression, the offshore industry. And if we don't continue to spend money there, we will see oil production go down. And that's just not probably going to happen. So higher spending equals offshore services recovery. As you can see, the number of new contracts awarded from 16, 17, and 18 has been going up. It's up 65% over the last couple years. And the number of offshore rig tenders is up 26%. So, despite lower year-to-year oil prices, the number of open tenders for offshore rigs has increased as compared to a year ago, demonstrating the improvement in offshore project economics and cash flows. Now, I don't believe this is going to be a V-shaped recovery. There's a lot of idle equipment out there, but I would suggest that some of that equipment's been sitting on cold stack for a while, and it costs a lot of money in some cases, particularly in the offshore roll-on, roll-off boats and service boats. A lot of those things have been sitting in yards or sitting for several years. And if you have a 20-year boat that's been sitting and needs several $1 million prepared to go back to sea, I think a lot of things are going to go to scrap. So that's what we think will happen. There'll be some more write-downs. Same thing in the offshore rig industry. You really have to look at the companies, I think, as this thing develops over the next couple of years. You don't want to be involved with companies that have a tremendous amount of debt that's due this year or next year. But like a company like Ensco, they really don't have any major debt payments due until like 2022 or 2023. And, if we get that far out and the debt kills us, then we were wrong anyway. So I think this thing, 19, 20, 21, I think this thing comes back. What are the risks? Okay, let's talk about the risks. If we have another 2008 great financial crisis, world depression, and oil prices crash and stay down, then that would delay an eventual oil field and oil price recovery. But, the world doesn't end. There are, 70 million people are added every year to the population of the earth. People are industrializing, urbanizing, becoming wealthier. Petroleum demand continues to increase per capita. We can talk about renewables all day. I don't think they become significant for a couple decades, so I'm not going to get into that. Long story short, we could have oversupply. It depends. I mean, you have to watch the oil price. If the oil price crashes, if you think we're going to go into a world depression, or OPEC won't be able to moderate or move prices higher, if you think shale is just going to continue to grow and grow and grow, then this probably isn't going to be the place where you want to be. I don't believe those things. I think that we're getting to the end of the shale revolution, if you will. Yes, we will continue to see some growth, but eventually these things are going to peak out. And I don't believe, I've said before, 4 counties in West Texas can carry the demand growth plus depletion for the entire earth. I mean, the bottom line is the crude quality is very high, sweet crude, and it's not necessarily in demand all over the world. There's kind of a glut in that type of oil. And like I said, you have to watch. Crude quality does matter. So that was a quick and dirty on oil. I'm getting more excited about it. I think there is tremendous opportunity. We've had some false starts in the past, but I think even the people in the industry now are starting to see the turnaround. They're starting to see the green shoots, if you will, and prices are way down. This thing's been given up by even people in the industry and definitely by generalist investors. And if the sentiment shifts, and if we can get oil prices up to $70 or $80 a barrel by the later on in this year, there's definitely going to see interest come back into this to this area. Money will flow into this area. And I specifically think that money is going to, as sentiment shifts, money is going to shift out of shale and move into the heavy oil names, particularly in Canada, as the realization that there is going to be a less available supply of heavy crude to supply those U.S. Gulf Coast refineries finally sets into people's heads. So that's it for this week, guys. Appreciate the listen. Keep the comments coming. Not much to say on uranium this week. Not a lot going on. We're still waiting for the 232 resolution. We expect that over the next month of April here. But I do want to say one thing. I'm seeing more and more people, outspoken influencers, Bill Gates and others, talking positively about nuclear power as a solution for climate change. And the Trump administration's been going great guns. I saw a recent conversation or speech given by Rick Perry, the Energy Secretary. Trump's mentioned it several times. I expect a very positive outcome for the 232. Trump is very nationalistic, and once it's explained to him that 20% of our electricity comes from nuclear power, and we produce less than 1% of our nuclear fuel, and we're relying on the Russians, I don't think that's going to sit well with him and Wilbur Ross and the rest of the gang in D.C. So expect a positive outcome there. I don't know what that means. It could, it could open the floodgates and we start seeing contracts remove quite a bit of uncertainty. It depends. I'm not sure. We'll have to wait and see. So that's it. Thanks for the support, and we'll talk to you next week.